So today's presentation is really broken down into five parts. I'll start with the market environment, the fund itself, our strategy, the portfolio, and then the offering details. So let's get started. National vacancy rate. Well, the national vacancy rate is below the 34-year average, and that is below Canada's rental market, which has historically been extremely tight. Purpose-built rentals have had a vacancy rate of, as you can see, 2.2%. Again, well below that 3.1% average. In our view, this isn't a soft market, it's a chronically undersupplied one, and it will certainly keep pressure on renters nationwide. Housing starts are certainly lagging behind demand. Canada needs over 3.1 million new homes by 2030. That, simple math, equates to 426,000 units per year. We haven't built anything near that in decades. Canada welcomes nearly 10 times more people than they lose. Demand certainly hasn't disappeared, it's only paused. The supply gap will only amplify upward pressure on rents going forward. CMHC data certainly confirms that our core thesis that vacancy rates are significantly higher in new, more expensive buildings, those buildings built 2000 and onwards, and lowest in affordable established assets built between 1960 and 1999. And that is the exact vintage that Pier 4 is focused in on. So really across all provinces, these mature assets consistently deliver lower vacancy, stronger affordability, more stable cash flows, and certainly insulation from luxury oversupply. The chart here, both reinforce this insight that renters prefer well-located, affordable, established rental stock. Pier 4 strategy is directly aligned with this demand. Growing markets leading Canada's average rental growth. So here, as you can see, it really is Atlantic Canada which continues to lead the country in rental growth. And the data is clear. The national rental growth across the country grew roughly 24.8% over the past several years. But as you can see, New Brunswick grew 32%, Nova Scotia a little over 30%. And these markets certainly have significantly outperformed. As the chart shows, strong migration flows, the Atlantic Immigration Program being a key catalyst, as well as interprovincial migration, are really driving sustained outsized demand in these markets. Meanwhile, Ontario's slower growth isn't really a weakness, it's an opportunity. Stabilizing rents, persistent demand, and chronic supply constraints really do create an ideal condition for value add repositioning and operational improvements, really setting the stage for future upside. The key takeaway: high growth Atlantic markets continue to outperform, while mature markets like Ontario offer strategic entry points for the long term value investor. Moving on. So these cities here are really shaping the rental growth across the entire country. Average rental growth, as mentioned, is 24%. Cities where Pier 4 is active really are at the forefront of this national rental growth. So just to draw your attention to the slide, from Halifax to the left are some of the key markets in which Pier 4 is focused in on. So as evidenced by the slide, from 2021 even through last year, 2025, we saw Moncton Rents rise 31%. Halifax, as I mentioned, 30%. Kitchener-Waterloo, 27%. These are not speculative markets. They are high demand, low supply centers with stable employment and strong fundamentals. Pier 4 focuses on these markets really with sustained population growth, persistent rental, low vacancy rates, really where demand consistently outperforms supply. This is a really interesting slide and something that certainly has become quite relevant of late. So here we are depicting the historical correlation between interest rates and cap rates. So we are here really highlighting the relationship between the 10-year Government of Canada bond yields and cap rates. Lower interest rates have historically led to cap rate compression, which can certainly drive real estate valuations. So from 2021 through all of last year, spreads between bond yields and cap rates have certainly fluctuated. The multifamily space has certainly proven quite resilient. Moving on to the fund. Here's a fund overview as of December 31st, 2025. So our weighted average appraised cap rate is 4.5%. 41 properties. The asterisk donates a property we are closing in on in Q3, and I'm happy to share. We also have another one currently under contract closing in Q3 and 4 LOIs out currently. So hopefully some very good news to certainly share in the coming weeks. Once we close on that property, the 41st property will have a little over 2,000 units. Our occupancy rate is quite strong at just shy of 97%. We have a targeted distribution of 8%, which historically has been 100% return of capital, so extremely tax efficient. Our NAV, or our net asset value, today is $11.35, and I'm happy to share we are anticipating a meaningful NAV increase, and in the coming slides, I'll shed some light as to the why. We have a targeted return strategy of 12 to 15%, which is made up of the 8% distribution plus the capital appreciation of our underlying assets, in this case, the buildings. And I'm happy to share, certainly across all share classes, we returned anywhere from 12 to 14.5%. We've also internalized all property management and renovation, which in itself is one of many key differentiators and a competitive advantage. Fund growth since inception. So just to draw your attention, we'll move from left to right. Pier 4 came to be Q2 2020. We closed out the year with an AUM of 6.7 million, 4 properties, 73 total units. Just to draw your attention to the middle of the slide, 2023 AUM, we crossed that $100 million threshold. The portfolio consisted of 18 properties, 493 units. We saw a unit price increase. In fact, this would have been our third. We launched the fund at a NAV of $10. We went to $10.30 and then closed out 2023 at $10.55. And then just to fast forward to where we are now in Q2, as you can see, with that property we're expecting to close in the coming weeks, AUM, in fact, will be north of 435 million, 41 properties, over 2,000 doors. And certainly by any measurement, any metric, I think you will all agree this has been strong, consistent growth, and we are in our 6th year. Investment growth since inception. So as you can see, strong, consistent, dare I say, predictable. On the right-hand side, return history for our DRIP as well as cash has ranged anywhere from high 10s to certainly 12+%. And then an investment in Class A cash since inception, that cumulative return just shy of 60%. Returns and volatility. So certainly compared, if you look at the time frame between 2020 through 2025, compared to other investments, Pier 4 really has delivered high returns with low levels of volatility. The Sharpe ratio on the right-hand side of 5.56 or 5.69 is certainly far above the threshold of 3.0, which is considered excellent. Advisors really do use Pier 4 to stabilize portfolios without sacrificing returns. So who's behind Pier 4? Well, Pier 4 is a family-owned multifamily REIT, really built on more than 40 years of real estate experience in property ownership, management, and value add improvements. The Ashby family ran and operated a very successful renovation company dating back to 1981, really working with some of Canada's largest landlords, and then later expanding into their own portfolio in the early 2000s. Today, Pier 4 operates out of three major cities. Our head office is in downtown Toronto at York and Wellington. We have an office in Cambridge, Ontario, which serves as a property hub for our expanding portfolio in southwestern Ontario. We have an office in Moncton, which serves as a property hub for our expanding portfolio in the Atlantic provinces. Today, we are actually at 92 employees. We're growing across every single department. Most of the new hires, certainly over the last six months, maybe even up to a year, really been have on the property management side. We're a comprehensive asset and property management service company, collectively well over 100 plus years of combined real estate industry experience. And I think just as impressive, a trusted network of over 3,000 trusted investors. We've been fortunate because we've been able to execute. We've been awarded many accolades. Last year was the second year in a row that we were recognized as one of Canada's fastest growing companies. So certainly independent directors, trustees, governance without question is certainly crucial to our success. We select industry professionals to really oversee the fund's management and affairs. They provide oversight of our standards, policies, strategies, budgets, and property targets. Moving on. So our philosophy is really quite simple. Our mission has always been to deliver consistent returns for our investors while also providing our tenants with a comfortable, secure, and affordable home. We do offer true transparency, and we look to maximize investor returns. In terms of our strategy, well, we are really focused in on, as I mentioned from the outset, on acquiring value add real estate assets. We want to optimize profitability. We certainly want to maximize investor returns. So, how do we do that? Well, through a disciplined triple R approach. Realize we acquire off-market, undermanaged assets with strong upside potential. Revitalize. We want to enhance the intrinsic value via renovations and operational improvements. And then certainly from a return perspective, whether that be the monthly distributions and or long-term net asset value growth. On the right-hand side, very, very important and another key distinguishing and competitive advantage. As mentioned, we've internalized renovations. So our average renovation cost across the entire portfolio since inception is $15,000. So context. We have a three-tier institutional approach to renovation. On the bottom rung is bronze, something as simple as a new coat of paint or a new fresh coat of paint, hanging new curtains. Gold, Certainly that, plus stainless steel appliances, new cabinetry, and then platinum, something more fulsome, which costs roughly $27,000. And I'll show you an example on the next slide. That would also include hardwood floors, granite countertops. In doing so, we have been able to generate in excess of 50 plus million dollars in fair market value gained. Clearly, our strategy works. 51.21% portfolio gap to market. This is undeniably a competitive advantage that we certainly hold over our peer group. What is a portfolio gap to market? Well, very simply, that is the difference between in-place rents and market rents. That is our ability when someone moves out to raise rents. Also, it does provide tremendous downside protection. I think everyone is aware, certainly we've seen rents soften over the last year, year and a half. But because we do have that wide gap to market, we haven't missed a beat. Here's an example of a value add uh, building. This particular one is in Kitchener, Ontario on Onward Avenue. Purchased, as you can see, March 15, 2023. It's a 46 unit building. We purchased this for $6.6 million. Strategic upgrades. So, as you can see, we spent roughly $754,000. What did we do with that money? Well, we renovated 16 units, installed security cameras, corridor renovations, laundry room renovations, etc. As a result, we were able to increase rents from $920 to $1,307. What did that mean? Well, we saw value or the market value of the building increase to, come appraisal time, $10.7 million. That's a value add of a little over $4 million. So target improvements drove significant rent growth and contributed to a return on investment of 62%. On the right-hand side is just an example of our platinum renovation. I think you will all agree, certainly a much more inviting place to call home. Here's just another value add example. This particular building in Moncton, New Brunswick. This one on Elmwood Drive. And here we were able to increase after spending roughly $535,000 on various improvements, such as installing security cameras, lobby renovation, roof repairs, eaves trough, downspout replacements, able to raise in-place rents from $761 to $1,295, resulting in a return on investment of 50%. And again, just pre and post renovation pictures. If you have your phone, I encourage you to grab it, scan the QR code. This is a value add in action, if you will. For this particular example, or after you scan your slide, or sorry, the QR code, it'll take you to a YouTube video and you'll see the team in action. So essentially what we did here is we optimize underutilized space really to maximize asset performance and long-term returns. So in a building in Kitchener, Ontario, we essentially successfully converted previously unused storage lockers into two high-demand studio units. And in doing so, not only did we increase revenue or rental revenue, which increase our NOI, our net operating income, but it certainly absolutely enhanced the property's overall value. Here's another example. So again, grab your phone, scan that QR code. You'll see the team in action. This is just an example in Kitchener, and here we really, saw an opportunity to enhance the building Certainly the asset value by repositioning or repurposing, more specifically, underutilized storage space. So really through this strategic renovation, we converted the area into a modern junior one-bedroom unit, certainly optimizing functionality and livability. In terms of ESG, by reducing costs, we are certainly increasing the potential returns for our investors. So every unit, every building certainly benefits from Energy Star appliances, LED lighting, high efficiency boilers, water sense toilets, etc. Strong returns, responsible practices, meaningful impact. Moving on to the portfolio. Well, we often get asked, what kind of buildings do we buy? Again, we are focused in on acquiring low to mid-rise buildings. As you can see, brick exterior, concrete construction in strategic growing markets outside of metropolitan areas, really investing in opportunities often overlooked by others. So these value add opportunities are bought off market. These are buildings that, in a lot of cases, have been bought off mom and pop small partnerships. In pretty much every single case, have been owned for multiple decades. They just have not been run effectively or efficiently as a business, allowing us really to unlock that intrinsic value, increase NOI, that net operating income, increase the property value, and ultimately delivering and maximizing returns for our investors. So here are three properties which we added to the portfolio late last year. You can see the purchase price, certainly the building on the far left in Dartmouth, Nova Scotia, a very attractive gap to market of 93%. So again, rents increase after someone moves out. The team rolls in, executes on the renovation strategy. It is our goal to have a unit available for rent within 30 days. Moving on. Although the slide says under contract, I'm happy to share that certainly two of these buildings we have closed on, and the third one in the next couple of weeks. So from left to right, London, Ontario, this is by far and away our largest acquisition to date. Purchase price $102 million. This is 557 total units across 9 buildings. Works out to be roughly $184,000 per door. And I'm happy to share that the building was appraised at 12% above purchase price. So that will be accretive to the portfolio. Kitchener, Ontario, we closed on this roughly a week and a half ago. And certainly, as you can see, average rent $1,600, a modest gap to market. And we're certainly excited to add this to our growing footprint in the Kitchener-Waterloo area. And then in the next, I believe it's 2 weeks, we're closing in on Peterborough. This is our sort of first building moving east in Ontario. That'll make a little bit more sense when I show you the next slide. And this particular building was appraised at 19% above purchase price. So again, accretive to the portfolio. I share that with you in that, as mentioned earlier on, we are anticipating a NAV increase. So in terms of portfolio summary, once we close on the Peterborough building, we'll have 41 total properties across 13 communities, 3 provinces. As you can see, we have an expanding footprint, certainly in Ontario, Canada. Again, these are secondary markets outside of metropolitan core hubs. In a lot of cases, these are university towns, great infrastructure, fabulous connectivity. And then another clear differentiator is expanding footprint in Atlantic Canada. And if you remember, certainly from the earlier slides, these have been some of the fastest growing cities across the country. I do want to add that our pipeline is robust. Last I saw it, was well over 3,500 plus units, roughly $710 million that we're sort of looking at. Our team is active on a weekly basis. We underwrite anywhere from 7 to 10 deals. Last year alone, the whole team underwrote 164 total deals, but we only added 7 properties. So we don't buy a property for the sake of buying a property. It certainly has to meet our stringent metrics and needs. In terms of portfolio summary, just top left, again, Pier 4 came to be in 2020, 73 total units when we closed out the year. Fast forward to where we'll be in the next couple of weeks, just over 2,000 plus units and growing. AUM growth, again, end of 2020, $6.7 million, and will certainly be well north of 435 plus. And again, as I shared, a number of buildings that we have LOIs out. So again, hopefully some very exciting news to share as we continue to scale and add meaningful stock to our overall portfolio. Our portfolio gap to market, again, is 51.21%. So that is our ability to offer upside potential as well as downside protection should rents soften. And then just to break down by units by province and AUM by province. Moving on to the offering details. So all of these classes are available through Integrated Equities with the exception of Class F. That is for fee-based accounts. Key takeaways here, that each class pays an 8% targeted net distribution. So that's compounded annually, paid monthly. And again, historically has been 100% return of capital. So extremely tax efficient. And I'm also happy to share that we have never missed a distribution. We have a targeted return strategy of 12 to 15%. So again, that is the distribution plus the appreciation of the underlying assets. Obviously, in our case, the apartment buildings themselves. And certainly last year, every single class not only met the targeted return target, if you will, but in a lot of cases, depending upon the class, anywhere from again 12 to 14.5%. Our NAV is $11.35. Entry or participation can be for as little as $10,000. Some of these classes certainly are registered plan eligible. We do have trust and LP units. The LP units are more focused in on that open environment versus registered plan environment, offering further tax advantage savings and or strategy. And then certainly you can see the MERs, the management expense ratio. Depending upon which class, there are various lockup periods. They can range